virtual workshop, Understanding and Filing Taxes. Understand the basics whether you prepare your own or not. And now I would like to introduce our speaker, Laura Troost, and our club president, Beth Heiserman. And I'd like to share a little more about Laura with you. Laura has been a certified public accountant for nearly 20 years, a member of our club for the past 11, and she's also a past president of our club. Mrs. Troost worked in public accounting, preparing tax returns for individuals and business for the vast majority of her career. She's currently employed as the Chief Financial Officer for a cooperative that packs approximately 60% of the lemons sold by Sunkist. Ms. Troost has 3 children, ages 22, 17, and 12, and 2 ex-husbands. She enjoys exercise, reading, and the beach. And now, Laura, the stage is yours.
Good morning, ladies and gentlemen. Nice to be here, and hopefully we can share some information that's useful to you and is somewhat entertaining and not too dry. I would like to start off the presentation by doing a poll. This is normally attended by clients of Single Mothers Outreach and the Domestic Violence Center. So we have a little bit of different mix of attendees at this time. So would like to start with a poll so I kind of know what directions to focus on. So Beth, could you post the poll, please? So you guys could complete that and give me a gift on what we need to focus on. All right, so it looks like we've got a pretty good mix of people preparing their own and paying people. Not too many children under 17 and a mix of retirees and non-retirees. So with that, let me share my screen here. Off we go. So everyone, can you see my screen? Nodding, yes? Can you see my screen? No?
Yes.
Yes, it's up?
Yeah,
okay.
You're good.
So this is just intended to be an overview, to give you some basic concepts and understanding, and to give you an update on what's going on with the tax code so that you can ask the appropriate questions or look out for the appropriate things for yourself with all the changes that have happened. So the basic tax forms, pretty much everyone should be familiar with this, is the federal form 1040 and the California form 540. Basic tax concepts. So we're going to discuss these today. Filing status. Oh, calm down. Filing status is, married, single, dependents. You don't have a lot of people with people under 17, but you might have relatives that could be your dependents. These are people that you no longer get the personal exemption for, but there's other reasons to record dependents on tax returns for eligibility for credits and things like that. Items of income. What are the current above the line deductions? What is adjusted gross income? What is the difference between standard and itemized deductions? Some credits. These are mostly credits focused towards DV and SMO, people with young children and divorce. So might not spend much time on that today, and other taxes. So to make this a little more illustrative, I've got it in this format. So just so you get conceptually how income taxes work. You've got your income, you take away your above the line deductions to arrive at adjusted gross income. From there, you take away your standard or itemized deduction to arrive at your taxable income. A tax rate is applied to this taxable income to arrive at your tax. Then we reduce that amount for your credits, for your credits, some of which are refundable or not. So if your credits are more than your tax, sometimes you won't get the whole thing depending on the type of credit. And then we add back any other miscellaneous taxes, such as it's mostly high income earner things, net investment tax, I'm drawing a blank, self-employment tax are the big ones. And then you arrive at your tax due or refundable. So here we are. So filing statuses. So single, pretty straightforward. You're unmarried or separated from your spouse on December 31st. Married filing separate, it's whether you're, it's for married individuals, whether you're living together or not. Married filing separate isn't a popular filing status in California because California is a community property state. So it requires a lot of adjustments to prepare a married filing separate return. And the tax consequences are usually not beneficial. You end up paying more tax generally married filing separate. The common times we see that is if you're fleeing a domestic abuse situation. And in that case, you get all the benefits of being married filing jointly. You just don't have to deal with your ex. So that's when I usually see married filing separate. Married filing jointly, and it's for married people, whether you're living together or not. In addition to that, we have head of household. Head of household is for individuals married, not married at the end of the year, and they paid more than half of the cost of keeping a home for a dependent. And qualifying widowers are people whose spouses have passed away within the past 2 years. So you kind of get to keep those married filing jointly rates for the most part and benefits for 2 years after your spouse dies, as long as you don't get remarried. So when are you required to file? This is one of the questions we had in the initial registration process. So when you're required to file is based upon your filing status, those items we just went over, the married, the single, the whatnot, and the amount of income and the type of income you received. So generally, very generally, you're required to file if for your filing status, you have gross income of at least this amount. You'll notice that married filing separately is $5. It is a garbage filing status. So you really don't want to do that unless you have to, but they want everybody who is the second spouse in that situation to file. Any questions on that? Any of this so far? Pretty basic. Additionally, you might have to file if you had self-employment income over $400. There's some special miscellaneous taxes we won't get into it. It's not going to apply to anybody here probably. If you made retirement distributions, you have to pay tax on those. If you had a nanny or somebody working in your home, if you get tips that you didn't pay your Medicare and Social Security on, and health savings account distributions, and also to reconcile any advance payments you had in the healthcare marketplace. If you got your health insurance out there on the California healthcare marketplace, and you have to reconcile your premium tax credit and see if you're over or under. Next concept on this is who is a dependent? We don't have a lot of people here with dependents, but basically it's your kid under the age of, ooh, sorry guys, this laptop's a little squirrely. Your kid or a qualifying relative who has less than $4,300 of income. You need to provide more than half their support. Generally, they live with you for more than half the year, and they can't be a dependent of someone else. That's the biggest problem in divorce, is coordinating the deduction of the dependents between the two former spouses. If both of you are going to if both of you are eligible to deduct the child as a dependent, there's some tiebreaker rules. We won't get into them since we're not really focusing on that today. And there's a form that should be filed when you're transferring the qualified dependent designation between spouses, the release of the claim to exemption. So next concept here. Now we're actually getting started on this concept, income, our first line here. Now that we know who's on the return and what our filing status is, let's talk about what income we have. So common types of income are wages, which are relatively straightforward, interest and dividends. And this nomenclature in the parentheses is what tax form you would receive to record this information. Interest and dividends, taxable refunds, alimony for divorce agreements signed before December 31st, 2018, business income, capital gains, IRA and pension distributions, rental income, unemployment, Social Security benefits, gambling winnings. And what I like to say when discussing this is you need to look at all of these as they come in and kind of give them a stink test. Do they make sense to you? Do they make sense to the cash you received? And look at the boxes and what they're saying, especially on these IRA and pension distributions. Do those make sense to you and what happened in the year? Because errors on these forms, they're hard to resolve last minute, and their errors on these forms can cost you a lot of money. So just look them over, make sure they make sense to you, open the mail as it comes in, don't just hand a pile of unopened envelopes to your accountant. Be active and be proactive so that you can save yourself some money. So there's some new legislation that impacts income this year. So people received these CARES Act payments early in the year. They were $1,200 per qualified individual and $500 per qualifying child under 17. And then right at the end of the year, they started sending out an additional $600 per qualified individual. Both were phased out at higher income levels. If you know that you're a higher income earner and you did not receive these payments, you weren't eligible for them. If you have questions about where those limits are, you go to the IRS. They have some really great tables out there. They're non-taxable. And also, if you received more than you were supposed to get, you don't have to pay it back, because I think they just can't figure out how to administer that right now. Other changes that weren't necessarily tied to legislation, virtual currency. Virtual currency is becoming a huge issue for income tax. The question has been on your tax return for the past year or two, but this year they moved the question as to whether you had any virtual currency transactions to the very top of your tax form. Make sure that gets completed, because a blank checkbox could cause you as many issues as saying yes and not having income. Just answer all the questions. Income exclusion of in-home supportive services. So these are payments that people receive from the government to take care of a disabled person in their home. And generally they receive a W-2 for these payments. There's been a lot of litigation on this back and forth as to whether they were taxable, whether you could receive the earned income credit for these earnings. The litigation on this seems to have reached a stopping point. The IRS has conceded, and these IHSS payments are not taxable. And if you paid tax on them in the past, you should amend your return. Most tax preparers have been backing them out, you putting the W-2 in and then backing them out. But just know that if you do receive these, the risk associated with them has gone away, because the IRS has finally conceded, and they've been deemed to not be taxable. Income exclusion for discharged student loans. They had just a spate of schools that went out of business, and that's what this is related to. If you have a student loan for a school that closed down completely, there's some, you can exclude those amounts from income. And cancellation of debt income exclusion. Several years ago, when we had a lot of people defaulting on their mortgages, there were exclusions available to people for cancellation of debt. So you didn't have to include those amounts in your taxable income. It originally expired in 2019, but during this last year, in December of 2019, they extended that. So that's still available to people. So if you paid on cancellation of debt income in the past couple of years, you need to look at that and see if you're eligible to exclude it now, because that was a retroactive change. So you might have already filed your tax return for 18 and 19 and paid tax on this amount. So if you had cancellation of debt, go back, bring it up, look at it, and see if there's money out there for you. And you can amend your 18 and 19 returns. Another big change this year was, as part of the Families First Act that was done, the CARES Act early in the year, they allowed for 401k distributions for coronavirus related issues. It necessarily wasn't people who had it personally but had to take care of someone or lost their job, they could take distributions up to $100,000 if the plan administrator adjusted the plan to allow it. It's not everybody. But if your plan administrator allowed it, and they were allowed distributions of up to $100,000, and these are for people who would have had the early withdrawal penalty, so under 59.5. And rather than taking the full amount you had distributed, you can recognize the income over 3 years if you were in that situation. So that's a nice benefit. And that is something you don't have to do. You can recognize it all in 1 year, because you're still going to pay regular income tax on those 401k distributions. It just gives you an opportunity to spread that out a little bit. As part of that legislation, they also allowed for 401k loans up to $100,000. Again, if the plan administrator allowed that, and certain repayments could be delayed for up to a year, which is really nice for people who needed cash. A big issue this year was unemployment compensation. So unemployment compensation would come to you on Form 1099-G, and had you participated in every single unemployment program available to you in California this year, you could have received up to $31,500. There's a variety of programs, and only regular unemployment had any withholding. So, and the unemployment withholding was only 10%. So this is going to be a huge issue for people when they get these 1099-Gs and realize how much tax they're going to have to pay on their unemployment benefits, because withholding was very minimal on these. Unusual income items this year also included Families First paid sick and family leave. So this was a benefit that employers paid up to 80 hours if you had the coronavirus, and I believe up to 400 hours if we were taking care of somebody or had to be home to take care of kids at school. It's treated as normal wages, and you'll receive a W-2 for it. There should have been normal withholding. It should be pretty straightforward. They also had a ton of emergency grants paid to students to get them home, to get them rolling at work home. This is mostly college students. As long as it was associated with the qualifying public emergency, which I can't imagine it wouldn't have been this year, it's not includable in income. You would receive a tax form for that though as well. So we've talked about the most common income items and the issues with income this year. Next item here is these above the line deductions. Am I going too fast, too slow? Nodding, good? Just be an hour of me talking at you guys, this is awkward. Most common above the line deductions. So most of them are self-employment items, half your self-employment tax, your retirement, your health insurance, educator expenses up to $250. That's a controversial topic this year, because technically expenses to get your home in order to, there's supposed to be expenses related to being in the classroom. And there's some debate as to whether expenses associated with getting your home office ready and to teach at home are includable. And I say, who's going to fight you on that? That's ridiculous. It should include any educator expenses, but technically it's for classroom expenses. Eligible IRA contributions, your health savings account deduction, alimony for those older divorces, student loan interest of up to $2,500, and tuition and fees deduction up to $4,000. These are actual above the line deductions of education related things. There are education credits, then there's these actual above the line deductions. And if you have a college student, you need to coordinate between these items and not double dip. So those were the above the line deductions. There's not really a lot there. They've really reduced the number of things that are available to you above the line. So then after we deducted those from our income, we arrive at our adjusted gross income. And now we're talking about deductions. This is the item that most people talk about on tax discussions. You know, am I getting all my deductions? Do I have all my deductions? What can I deduct? So first, you have a choice between the standard deduction and an itemized deduction. You will take the standard deduction if your itemized deductions are less than the standard deduction. So standard deduction is based on filing status, and these are the amounts for 2020, so take note. If you don't have itemized deductions anywhere near this amount, you don't need to gather all those documents. There's no point. But if you're even half that amount, you should gather them so that you can have someone review them and determine whether or not you're missing something. But if you have like $5,000 in deductions, I wouldn't even bother putting it all together, because you're just going to take the standard deduction end of day. So itemized deductions, the option, if you have more than the standard deduction, generally include these items here. So medical expenses. There are certain medical expenses, including long-term care insurance premiums up to $5,400. But in order to deduct $1 of medical expenses, they have to exceed 7.5% of your adjusted gross income. So in order for any of your medical expenses to count, they have to be more than 7.5% of this number. So if I had $90 of adjusted gross income, I would need at least $6.8 of medical expenses. Can you guys see that? Peggy's covering her eye like it's really tiny. Medical expenses to even have the 6.9, the next dollar, the seventh dollar will count. So I'd only get one at $7. Does that make sense? So if I had $8 of medical expenses, I would only get to deduct the difference, okay? Nothing counts on medical expenses until you reach that threshold. So you really have to look at your medical expenses to see if it's worth it to gather them. Medical insurance is included, but I see a lot of people gathering up all these receipts for medical expenses, and unless you are older or have a serious medical event or are paying an incredible amount for medical insurance, generally you're not going to get, or have extremely low income. Generally, there's not much there for people. State taxes paid a couple of years ago, they changed the rules so that your SALT, your state and local income taxes, only can be deducted up to $10,000. This seriously affected Californians because, of course, we pay quite a bit of state income tax. California does not conform to this concept. So on your California income tax, you need to gather all your taxes, even if they're much more than $10,000, because on your California state tax return, you'll take everything that isn't California state income tax. So it's an adjustment that you need to make sure happens, because just putting $10,000 in that box, California is not going to know how much of that was California state income tax or other items that are deductible in California. That's a big federal to state difference we have now. As a part of that, I believe it was the Job Tax Cuts and Jobs Creation Act of 2017, I think is what it was called. They also limited interest deductions on mortgages. So you can only deduct mortgage interest on mortgages totaling $750,000 if they're after 2018. It's acquisition debt only. Points are deductible as they relate to acquisition debt. And acquisition debt is buying or refinancing. It's related to the purchase of the property, not refinancing to pay off credit cards or something like that. Mortgage insurance premiums are deductible, and California does not limit in this way. So you need to keep a mind on that. If you have a very, very large mortgage, California is gonna look at that differently. Gifts to charity, you're allowed to deduct qualified deductions, qualified contributions to charities. There's quite a bit of rules in regards to substantiation, especially over $250. You need to make sure you have a receipt, and you should have received a letter or recognition from the not-for-profit in January, and it needs to be a 501c3. It needs to be an actual charitable organization. You can deduct both cash and non-cash items. You need to also have those receipts and proof on your non-cash items. Generally, it's nice to keep a detailed list and to use to determine the value of those non-cash items, like donations to Goodwill. I'd suggest going and seeing what they're for sale at Goodwill to kind of get an idea of value. It's up to you to assess what those value of those non-cash items are, as long as they're under $5,000. Over $5,000, there's no whole nother set of rules. So there's some new rules related to charitable contributions this year. So if you do not itemize your income tax return, if you do not take if you take the standard deduction, you can take up to $300 in an above the line deduction for qualified contributions. It's not just you get $300, you need to actually have made charitable contributions. It's $600 for merely filing joint in 2021. For 2020, it's only $300. For 2021, it's $600 because the legislation was written quite poorly and it was not clear as to whether it was per return or per individual. So there was a clarification on that, but the clarification only came through for 2021 returns. If you do itemized deductions, you are able to take a deduction for all of your qualified cash contributions this year up to 100% of your AGI. So in a normal tax year, you can only take charitable contributions for up to 60% of your AGI. You know, these are big numbers. So let's say you gave, usually when you see people hitting these limits is when they have an unusually low income year. So it's important this year, but they still made their regular giving out of their savings or somewhere, you know, other sources of income. Or people who have charitable contribution rollovers. If you gave a massive deduction a prior year, this is really beneficial to you because you'll be able to do more of a catch up on those charitable contributions and eat into that rollover quite a bit. It's also a planning opportunity. So for the 2021, it'll also be 100%. If any of you are planning on setting up a charitable foundation or an endowment, it's a nice year to do it because you'll be able to deduct it more quickly. They must be cash contributions for these increased limits and this $300 above the line, and you must comply with the normal substantiation requirements. You need a letter, you need proof of contribution. So here we are. We did the standard or itemized deduction, and we got to taxable income. So when we have our taxable income, we're going to apply tax to that. So the way it works is there is a graduated tax scale. So the first portion of your income, of that taxable income, is taxed at one rate, and then subsequent portions are taxed at higher rates, the graduated scale. So I'm going to leave this up here for a second for you guys to poke around and absorb it. This is available online. It's widely distributed, just the tax brackets for 2020. Not much of a change from last year, just a normal increase. So that's on normal income tax. There are lower rates for capital gains. You know, and these rates are not based on the amount of capital gains, it's based on your AGI as to what rate applies to you. There's also additional taxes for self-employment income to cover that Social Security and Medicare that wouldn't have been paid by your employer, and additional miscellaneous taxes for higher income earners. There's a whole spat of them now. So once we have our tax, we have to apply our credits that we're eligible for. Man, I'm doing good on time. So the most common credit is the dependent care credit. So this is related to when you have kids that are in daycare so you can work. It's $3,000 for one child, $6,000 for two or more, and it's for children under 13. And this credit is intended to help families while they're at, you know, having childcare for while you're at work or at school or looking for work. And it ranges from 20 to 35% of your expenses depending on your income level. And it's non-refundable. And if you are married, both of you have to be work, school, looking for work. You can't have somebody that is unemployed and not looking for work and not going to school and still get this credit in a marriage. If you're in a divorce situation, the custodial parent can claim this child dependent care credit even if they've given up the dependency and filed that 8332 with their ex. There's special rules on this dependent care credit, so you can have that benefit for looking for work. With respect to this, if your employer does offer pre-tax, has a drawing a blank as to the number of if your employer offers a plan where you can take pre-tax dollars and have an accountable plan through your employer to pay for your dependent care costs, you need to evaluate between those pre-tax dollars and this credit as to which one is more beneficial for you. And I would do that by Googling calculators, dependent care calculators online, and you can put in your income, because depending upon your situation, either this credit or your pre-tax dollars out of your paycheck would be more beneficial to you. So this is something that especially people who are making a little more money need to look at, because it might not be the most beneficial for them, because you only get one or the other. Child tax credits, $2,000 per qualifying child, and you can also do $500 for those non-child dependents, like your parents living with you. Education credits, these haven't changed in a long time. It's the American Opportunity for your first 4 years of school, max of $2,500 per student, and a lifetime learning credit, which isn't tied to your first few years of school. And don't forget, we have that tuition and fees deduction. You need to coordinate between the above the line deduction, which is more valuable, and then these credits, which are reduction of tax. Whew. There's some special rules on going back and forth on who can take the credit. Generally, if you're a dependent, your parents can only take it, not you. Even if you qualify as a dependent, but your parent does not take you, then the student can. I had my daughter graduate college a couple of years, and it took us every year, the first couple of years, to determine whether it was more beneficial for us to take the credit or for her to take the credit, and how our tax universe as a whole was going to work out. So I encourage you, if you do have students, rather than just you taking the credit or them taking the credit, have the same person prepare both tax returns so that this can be evaluated, so that your tax family has the greatest savings. We also have the earned income credit. This is a credit that is a refundable credit based on earned income. This is for the working poor, is what it's designed to assist. So it has very low earned income levels, and this is a credit you can get back even if you haven't paid tax. So with respect to the earned income credit, it can be wonderful for people who need it. It is an area of high fraud, and there's a lot of questionnaires and documentation associated with it. Be sure to complete all of that to avoid issues later on, because the IRS does look at these, because it is an area that a lot of people have taken unfair advantage of. California also has an earned income credit. They're not as audit aggressive on it as the federal is. And California used to not allow business income in their earned income credit calculation, and now they do. It's been around 3 or 4 years now. There's also a favors credit. So this was new, not that long ago, maybe in the past 5 years. You have to be over 18 and not a full-time student or dependent of another, and you can get a credit for saving. I feel that this is often forgotten, and it's available if you're making contributions to your 401k, Simple, SEP, IRA, traditional, Roth, and other qualified retirement plans. And it's for people with AGI below these levels. So don't forget it. Keep it in mind. Make sure it's on your return if you're within that range and you're making contributions to your retirement, putting away money for the future. California also has a non-refundable renter's credit. You have to be a California resident for the whole year. And if your income is within these levels for single and married filing jointly, you can get a little credit for renting. You do have to have the name of the landlord. I think it's just the name and address. I haven't done one of these in a minute. Pretty simple, pretty easy money for if you're renting, but very easy to forget and very commonly forgotten. Affordable Care Act. We all have to have health insurance, but there's no penalty. So I don't know what this is all about right now. Just that they say you have to have health insurance, but they're not going to penalize you for it. But there is the health insurance marketplace that we've had for several years now. It's out there in Covered California. If you do not have health insurance through your employer or through Medicare, you can go out there and get some help and get a premium tax credit to help pay for it. So it's the premium tax credit is an advanceable credit based on the lowest cost silver plan, and it helps subsidize your purchase of health insurance through the state exchange. That is one reason why, if you don't work and you did get this, you would have to file a tax return just so you can reconcile whether you got the right amount of the premium tax credit. The amount of the credit is based on the size of the family and the percentage of the federal poverty line that their income falls within. any difference between the credit and the actual payment or claim, actual amount paid for health insurance and your income, you're going to have to pay the difference on your tax return. So this is the reason why you have to file a tax return, even if you didn't have any income or enough to keep you off of Medi-Cal. It's become pretty standard the past few years. People seem to have figured it out. California also has their own health insurance mandate. So if you didn't have health insurance in the state of California, there's additional penalties this year. I didn't look into that too much, but just know that it's out there that there is a California health insurance mandate now. So for preparing your tax returns, we got through our credits. I'm not going to get into the other taxes because most of them are for higher wage earners and special income situations and quite detailed. Got to our tax due or refundable. So we're done with our actual tax cost calculation. I'm just going to talk about where you can get your taxes done a little bit or how. So you can go online, you can do the TurboTax and all those good things. Usually there's a VITA program, and a VITA program is a volunteer income tax assistance program. And it's people, volunteers, accountants, students who are trained and supervised under guidance provided by the IRS to help people prepare their own tax returns. It's not they're going to do your tax return for you, but they'll help you out. And often they have these at like senior centers and at colleges. There's nothing anywhere near us this year except for CSUN, and it doesn't even say when there's going to be appointments or how this is going to work. So I don't know if there's going to be a VITA program available for us this year. And that's unfortunate. And I also, in looking at the IRS website and whatnot, I have a feeling they may extend the tax deadline again, like they did last year. They haven't said anything quite yet on it, but I have a feeling because of some of these things being unavailable, they're going to give people more time, and just the complexity of our world right now. So to file your federal return, you can just go to irs.gov. They have a whole list of ways you can file. You can file for free through their website if you have a relatively simplistic return. They have like a little wizard that'll help you find the least expensive way to do your tax return. And then if you're going to file your own through California, California's software is a little more robust, and they actually pull in what they already know about you. So kind of creepy, kind of neat, but they have their free Cal file system out there. The only issue with doing the Cal file and the IRS website directly versus using a TurboTax or other tax software website is that you may have to enter things twice. And if you do that, just be very conscientious and careful. And of course, do your federal tax return first. So that's all I had for the basic presentation. We had some questions that came out before the class. This first one, if I am unemployed and have a 401k when I file my taxes, will it still be tax deferred? Yes. Your 401k does not immediately become taxable when you separate from employment. If you took a distribution, of course, you may have tax consequences depending on the amount and type of distribution. But if you just left your money in your 401k, you shouldn't have any issues. You may have to move it. Some employers won't allow you to leave it there, or they may charge you fees to keep it there. But talk to your plan administrator, talk to your HR from your former employer. They still need to talk to you, even if you don't work there anymore, about your 401k, and ask them. That's what they're there for. If I haven't worked, can I file taxes? You can, and you may want to, and you may have to. It depends on how much we talked about filing requirements and those income levels. There's actually a wizard on the federal IRS website that you can go through to determine if you need to file taxes, if you're unsure based on what you've heard today. You may want to file taxes to get, if you had a little bit of earned income credit, to get that earned income credit, or to report and reconcile your Affordable Care Act, your premium advances. So even if you don't have to, you may want to. You need to think about your entire situation and whether it makes sense. We went over those changes for, this one's how my charitable contributions treated for 2020 taxes. We went over those changes, so a little more opportunity to deduct charitable contributions if you're a high charitable, you like to make big charitable contributions. And the last one was, how does gifting affect taxes? So gift tax is separate from income tax. Usually the donor pays the tax. If you've paid, and you have a $15,000 exclusion each year for gifting. So if you gave less than $15,000, you don't need to do anything with this, but you should keep track of that. And if you're a regular donor, you might want to still do a gifting return. So married filing joint, that's $30,000. The purpose of gift taxes and tracking gifting is to keep track of your taxable estate. The state tax laws have been all over the place. So I just recommend being conservative on this so you don't have problems if they swing another direction. But as long as you're giving less than $15,000 for you and $15,000 for your husband, you're not going to have to file a gift tax return. If you have a larger gift, you really need to contact the tax professional, because especially if it's not cash, because there is a lot of paperwork to be done to make sure your taxable estate is tracked properly. So at that time, that's all I have for you. So we have time for some questions. Does anyone have any questions?
Laura?
Yes.
Laura, can you go back to the slide on the standard deduction and the additional deductions for 65 and older,
Yes.
please?
Let me do it this way. No problem.
Right.
Okay. But could you explain the additional for each filer age 65 and older on the 1300 and the 1650?
So if you're married filing joint and you get the 24,800, and then if you are over 65 or older or blind, you get 1,300. And if your spouse is one of those things, you get 1,300. You don't get 1,300 for every one of those things you are.
Okay,
So
right.
it's just 1,300 if you're one of those things.
Okay. All right. So it'd be the 24,800 plus 1,300.
Correct.
Okay. Thank you.
Per spouse?
Per spouse.
Okay.
We have a question in the chat from Mary. I think I heard the 1,200 received as part of CARES does not get taxed or declared. And if it was overpaid, okay to keep it.
Yes. She's correct on all that.
Okay.
That's wild. There's a lot of discussion about overpayments on those benefits and things sent to people recently deceased and how all that was going to be tracked. And honestly, it seems like it was so disorganized when it all went out that they just said, we can't, just keep it. So it's a credit on your return, but if you're over underpaid, there's nothing to be done. Good morning, Ms. Campbell. Any other questions or comments or things you want to get into?
Yes, I can. Yeah. I have a question, Laura. Are the required distributions being taxed this year? I thought I heard somebody say they would not be taxed this year.
You know, I didn't look at that because I was more focused on the divorce and things like that that didn't end up being an issue.
Mhm.
I can get back to you, Peggy, on that.
Okay, thank you.
I don't follow that closely. I'm not preparing taxes anymore for my career, so I've been well, you could skip your RMD, it said, just reading this real quick, it said you could skip taking your RMD. That didn't say you could skip paying tax on it, but I'll look at it and make a note to send you an email.
Great, I'd appreciate that. Thank you.
No problem.
I have a quick question, and it's about
Yeah.
Bitcoin. So now there's a line where you can go ahead
Tell
and
them to stop. Just tell them to stop.
Okay.
Yeah. Yes, you have. There's a checkbox where you have to report your Bitcoin and your virtual transactions.
Right.
Is it?
Oh, I have no idea. Like that's just internet gaming. So.
Yeah, he needs to. I'm not clear on if all those virtual currency websites will even send you anything or what that looks like. It's pretty much the Wild West with virtual currencies, and I don't think that we figured out administratively through our government how to track them or to enforce anything with them. He needs to keep track because they can follow his cash.
Mhm.
So just keep track and report them honestly. That's the best you can do at this point. I mean, just make sure the cash in and out equals the cash in and out. Whatever happens out there in the universe, I don't know. If you trade, there's a lot of discussion if you trade Bitcoin for, Roblox or whatever money, like there's
Oh my God. Yeah.
exchanges where you can do crazy stuff. And I don't even know how the IRS is going to keep up with that.
Got it. All right. Thanks.
Follow the cash. If you think of any questions later, you can give me an email. My personal email address is, as always, Laura, Laura, @hotmail.com. Be happy to answer it. I might not be extremely timely. I'm working a lot right now. I appreciate all of you coming. If you have any suggestions, I'm not teaching this class ever again because I'm not preparing taxes anymore. I had to do 10 hours of catch-up CPE to do this. And I appreciate all you coming, and just let me know if you have any questions, comments, or concerns, and have a wonderful day and stay safe.
Thank you, Laura.
Thanks.
Yeah,
Very
so-
informative.
Yes, so anyway, I also wanted to thank Laura for providing this information regarding our 2020 taxes during this pandemic time. And I would like to thank everyone for attending. Our next workshop scheduled for January the 30th will be You're the Boss of Your Money. Make it work for you. We'll provide advice about managing your money, presented by Patty Handy, who is now a wealth advisor with Vance Wealth, and Sue Twaddell, who is Regional Vice President and Investment Advisor Representative for Primercia Advisor.
Primerica.
Primerica. Oh, geez, I left an A out. Bad fingers. So you will learn important things about how to establish credit and how to manage money during these COVID-19 times. A flyer will be forthcoming in the near future. And now when you log off, an evaluation form will be available for completion. And we ask that you provide your comments which will remain confidential. This information is very important to us as you let us know how the workshop was relevant and helpful to issues you are experiencing. And we also ask for future workshop topics that are of interest to you. So thanks again for joining us.
Thank you, Phyllis, for putting it on.
Thank you.
Thank you.
My pleasure.
Thank you.